Well, hello members and welcome to this week's show. Happy holidays to you. It's May 29th. This is the weekly review. Take a look at what happened, maybe what we can expect for the coming weeks. You know, the big thing last week was NASDAQ. NASDAQ has been a laggard pretty much all year. Kicked into gear 3.5% almost on the upside. Almost brings it back to even on the year. That was the big thing last week. But just in general, right, a huge move up. More than we expected. We expected a pushback up to resistance, and this did more than was expected. When you do more than expected, you know, a basic rule here is that you should expect it to be telling you something. In other words, you know, when the strength is more than you think it's going to be, then you have to suspect that it's trying to tell you something. Now, sometimes there can be aberrations, right, where it's, you know, it's kind of a false move, but most of the time, it really is telling you something, so we have to keep that in the back of our mind here. As far as what happened, you know, on the indexes, we surged to not only the top of the range, but even beyond it. So if we pull up the S&P 500 here, if you remember, we were talking about this range, this lower range down here that went up to about the top of that swing point high there, and then on up to the tops, right? And that equalized range, you know, when we pushed up, you know, I expected last week that we'd get a push up to this area. Well, not only did we get that, we got continuation above that and just continued on higher. And now we're up here facing this swing point high. Now the high of that bar, if we you know measure up again, is 2073, almost 2074. We closed just oops, I got the wrong number there. The high 2099.30, and we closed just underneath it, 29,906. So you have to expect that this week we're going to try and break over that and at least take that last swing point high out. Now these moves are young at this point. In other words, we don't have, you know, if we're looking at the mean time to failures, in most of the indexes and in the sectors, they've just turned bullish on the short-term time frame. So they actually can continue for some period of time. So that's another factor that we have to keep in mind. Yeah, a lot of times when you cross a swing point high, you'll get a reversal or retest regen. Remember, because about 82% of the time that's what happens. So we do have to expect that we will get some sort of a retrace here. But the fact that we pushed much farther than expected, we didn't find resistance in this area, and we continued on, that says that this is going to be the support area when we get the retrace. If we move to the weekly chart and take a look at it, the other thing that's happening here is, let's grab the weekly chart, is that we have that same pattern that we had before. And I'm going to point out, you know, this original move up last year, same sort of time frame. You get the same sort of thing, right? You eventually get the retrace. We eventually get the retrace, even though it formed in a different way. It was the same thing. And then you get, basically, in this case was a takeaway bar. Well, here you kind of take away all the bad stuff over the last 3 weeks and you're back at the highs. If we go to the next part of the scenario here, you get this continuation, right? This hanging up here at the highs, and then eventually you roll back over. The question is are we going to see that same sort of pattern here where we kind of hang and then eventually roll back over? Now there are some differences now between then and what we see now. And let's talk about what those are real quick. You know, the difference in the sentiment is decidedly more bearish. And that's actually a bullish thing, right? So, you know, if you look at how much sentiment is bearish versus bullish and how many's on the fence, it's decidedly bearish on the fence. Very few bulls out there. And you see that not only in the sentiment numbers that you can pull up, but you also see it like in this put-call ratio, and I can show you that, where if we come here to the resources, come to put-call ratio, and then pull this chart up a little bit, you can see it here. You know, you're almost at the bearish extreme on a longer-term basis, and so, you know, that itself is a bullish thing. It's not a bearish thing when you get up here and you get to these kinds of levels. If you go back and line these up, you'll see that each time you've gotten up in here, you've gotten a pretty big rally off of that. Now, you know, this kind could be different, but the fact that, you know, this lines up, the sentiment lines up, This breadth, the market breadth, looks better this time around. In other words, if I look at the trends and the transition of trends, we're not seeing in that push down for 3 weeks, we didn't see much deterioration in that trend transitions from bullish to bearish or bullish to sideways. And so, overall, this feels and looks different than it did last year when we're looking at that S&P chart. It doesn't look to be the same. The other big piece of this was the NASDAQ being the leader. When all this year we've seen the NASDAQ, the NDX, not be the leader. Now you had a huge spike percentage-wise on the NASDAQ, which is very different than what we saw all year long. Yeah, we've seen the NASDAQ be able to push up, but nothing like it did this time. And if I go to the weekly here, you can see it more clearly, right? We've seen it push up, right? But it wasn't the leader. It was the laggard. It was being pulled up by other things. This time it was the leader. If that kind of action continues, then the NASDAQ is definitely going to tell us something, because we're a long way from the highs on the NASDAQ compared to the S&P. Highs up here 52.30. We're sitting at 49, right? So we're still 300 points, which is 7%. The S&P is 2%. And so there's a big difference between these two. If this becomes the leader, the S&P is going to break those all-time highs. And so that, to me, is a big difference than what we've seen before. If we look at the sector views, right, the SOX was extremely strong. Starting last week on Friday when we had the AMAT earnings, this thing started to break out. Well, it just continued day after day last week. Breaks 3 swing point highs here, breaks a swing point high on this. This, again, if we go to our neoclassical playbook, this should continue even after this surge. If that holds true, again, this is a large piece of the NDX, the NASDAQ, that's going to help that part of the index continue even higher. But it doesn't stop just with the SOX. I mean, you've also got other parts of this index, like the tech software sector, right? This sector also breaking out on the daily, trying to break out on the weekly. If we look at the FDN, right, which is the internet ETF, breaks out last week, a continuation back towards the highs to this breakdown bar, trying to get up and over it. And finally, if we look even at social media, SOCL, there we saw the same sort of action with a breakout over this swing point high, the retest, and even though it got under it 1 bar, it was back over it, and then continuation to the upside. Looking at it on a weekly, we can see it's coming back to the top of its breakdown bar as well. We also had the big cap tech stocks continuing to power higher. For example, Apple, off the Buffett news a week earlier, continues up. It gets over the top of this gap down area. It's up there. It's starting to stall. But you've got the same thing happening in Microsoft and Google. All 3 of the big cap tech stocks, which are about 33% of the weighting, or about 30% of the weighting of the NDX, they've all pushed back higher last week and continue to power this up. Now, what you should realize with the FDN, with the social media, with these stocks that I'm showing now, Google and Microsoft, they're all coming back to the tops of areas where they should find resistance. And so, when we're looking at these, we have to realize that they've made nice moves. Now they're back up to points where resistance should start to kick in again. So we're on that cusp of something bigger to the top side, probably consolidation, which leads us into this idea here that the next few weeks are probably going to be critical. There's so many bets aligned against a further rise in these indexes that you have to wonder if we're going to get some sort of a push that makes everyone want to get in. In other words, there's so much money that is idled, if you will, in terms of not being in the market. Yet the market has been able to hold up throughout this whole time consolidation. If we go, let me pull up the S&P again. and pull over the monthly chart, if we look at the monthly chart, right, we've never broken. We've come down, we've tested this area, but we never broke it. And now we're on the cusp of potentially trying to break the top side again. And so this long consolidation that's been taking place continues to take place over a 2-year period. Might it be that this long move up is simply going to consolidate and then try to break higher one more time? I mean, that's certainly a possibility, even though it's not, what we've expected all along. It's something that we have to entertain, and we can't forget that, we could get a break to the top side and have, if this happens to happen, then you're going to have anyone that's not in the market scrambling potentially to get in the market. That's the risk to the upside. That's the I can't, get left out, the train's leaving the station type of thing. And even though, it's hard for me to imagine the fundamentals that would support that kind of a move, you could certainly get that kind of a move before you come back down again. And so I don't want to dismiss the possibility of a 5 or 6 or 7% rise off just a breakout that becomes nothing more than a squeeze to get in, because it's the fear of missing out. And so then the question, of course, is how do we know that's taking place? Well, if we get on a weekly basis, let me pull up the weekly, if we get a push back over this breakdown area, in particular this bar is the important bar, 2103, if we can get over that, hold it, and not fail, then potentially that is what's going to happen. And there's two ways to play that. One is to assume that any breakout above this area is going to come back and retest regen, and I think that's probably a pretty good bet. But one could take exposure on a break of this area and then hold it, right? See if you get up there and come back and hold, and then start to move higher and then add again on that breakout. And so this becomes the critical bar. I think the next couple weeks become the critical weeks. You have the Fed meeting coming up into the month in June. You've got the Brexit situation, the vote taking place in Europe. You actually have the European Union, the ECB this week. So there's a lot of economic news because it's the beginning of the month. And so there's a lot happening. If we can hold over the next week or two, that squeeze higher might become the scenario that nobody expects that actually happens. As far as best case, worst case, last week it was even better than expected. We were expecting a push back to the highs. We're expecting a push up and then consolidation. We actually got a push all the way back to the highs. What's the best case this week? It's come all the way back to the highs and potentially break them. That would be kind of an amazing feat, but I've seen more amazing things in the market over the years. What's worst case? You just reverse it all. You do a takeaway bar. I think this is an unlikely scenario. I think this one's somewhat unlikely. The more likely case is some consolidation base building here this week. And if we can do that for another week, week and a half, we may be able to go and try to break out those highs, which I'm sure is not the expected case in most people's mind. Well, that's it for this week. It's going to be a shortened week. I'll see you on Tuesday. Have a great one. Thanks. Take care.